Thank you, Jerry and Merritt, for being here. Really appreciate you taking the time to tell this group of entrepreneurs about Laconia Capital, how it works, what you look for. We're going to go through all of it. So to get started, we want to hear more about each of your backgrounds and how you ended up where you are today. So maybe we can start with Jerry, and then we'll go to Merritt. Great.
Sounds good. Great to meet everyone. My name is Jerry Kirilova. I'm one of the partners on Laconia's investment team. I am originally from Bulgaria. My parents dragged me here when I was 2. Grew up in New York. Lived here basically my whole life. And I, for better or worse, have been on the early stage investing side for the last 10 years, give or take. So I started off at 2 funds in Europe, and then came back to New York and met my 2 partners, Jeffrey and David, at Laconia in 2015 or so. So that was early days of Fund 1. I've been involved in kind of building a new venture fund from the ground up. It's been wild. We have stories. We're very excited to be here and to learn more about what you're all building.
Awesome.
Amazing. Hi, I'm Nurit. I'm an investor at Laconia. I'm originally from Israel. I spent 8 years in London, and I moved to New York City 2 weeks before shelter in place was being declared. My boxes had arrived at the last day before everything got shut down. My background, similar to a lot of us at Laconia, there's only 4 of us, but 3 of us come from the operation side, apart from this girl who spent all her career in early stage VC. And I've spent 10 years building and scaling in B2B SaaS, primarily in fintech, data. And 3 years ago, I transitioned into venture capital. I spent time at 51 Unicorns, which is focusing on female retail investors investing in other women, and then at Seed Impact, which is a social impact platform for angel investors and social impact entrepreneurs, and was fortunate enough to join the Laconia team about a year ago. So super excited to be here today and learn about everyone and what you're building.
Awesome. So you spoke a little bit about Laconia already, but I want to hear more. What is Laconia's, the root of its thesis and what it looks for? How is it different from other firms?
Do you want to kick that off?
Yeah, definitely. So what we do at Laconia is we invest in early stage startups that are using software to solve high pain point problems. So we'll break down what that sentence means. The sentence is we invest in companies that are changing the way business is done. But what it means is that we invest in the early stage of companies. So we do pre-seed and seed investments. We invest in B2B software only, which means we're quite sector agnostic. But there are a few industries that we are excited about. We like to look at companies in retail and e-commerce enablement, which is where a lot of our expertise comes from, fintech, SMB tooling, vertical SaaS, and more recently, healthcare as well. But we will look at everything, under the sun that is B2B software. But I think what we're rooted in is just solving a high pain point problem. That's it. Our check sizes ranges between 250 to $1 million, with sweet spot of 250 to 750, and we can lead, co-lead, and follow.
That is exactly what we do.
Can
confirm.
About roughly how many investments do you make a year, and lead versus follow?
We're targeting 4 to 6 a year, so it's pretty concentrated for a seed fund. So we're investing out of our 3rd fund now. We're hoping to have 20 to 25 investments. We have 12, 13?
12. With 13 and 14 maybe on the go.
Being pushed across the finish line at the end of July, which is challenging. But we're pretty even split out of this current fund on leading or following. We actually, interestingly enough, we're leading more before. But it's just, I'm not sure, there's no good reason for why we've moved more into that follower. It's just, we've just been very opportunistic about it.
And we were fortunate to have founders that came to us at the right time, and the round was already kicking. I think there was one pre-seed that we've actually introduced them to the lead, and then kind of, we don't mind. That's what I love about Laconia. There's zero ego around leading, co-leading, percentage ownership. We have our fund construction and we make it work, but we really want to do what makes sense for the round. So if you found someone and you want them to lead, then we're happy to just be the co-lead or the follow.
For us, we're always looking at what's going to make the most sense for the round dynamics and what's going to give you the highest probability of success. So because we do, as Merritt mentioned, both pre-seed and seed, if it's a round that's below 3 million, call it, given our check size, we're totally fine and it makes sense for us to lead or co-lead. If someone comes to us and it's a little bit later in their journey and they're raising a $5 million seed round or something like that, it's not that we're not happy to commit and be like, yes, we're in, but leading a $5 million round with a $750K check has challenging round dynamics. So we're just sensitive to what's actually going to be the structure that makes the most sense and will get you where you need to go.
So that's really helpful to hear, because I think that one of the dynamics that's hard for founders to really understand is what happens if you're at a point where you do have multiple, you're lucky position, you have multiple VCs that are interested in investing and have put down term sheets, and you're like, I don't know how to deal with this because they're kind of in competition with each other, but I want to play nice with everyone.
Yeah.
So how does that change the dynamic? The fact that you're happy to play nice with other investors.
I think we try and communicate, and Jerry can talk about that. How do we think about it from a fund construction as well? But I think from the founder's perspective, we try and communicate with the founders about who we are from the get-go. So hopefully they know that even if they have competing term sheet, they can come to us and we can discuss it. I mean, there's multiple cases where we might not be the lead, but the founder comes to us and he's like, these are the term sheets I have. What's your view? What shall I do? What shall I progress with? Or there is a term sheet on the table. Do you want to join as a lead? I feel like from the start, we try to create a trust basis relationship with the founder. So when it does reaches those stages of term sheets are out, terms are being determined, whether it's a price or a safe, all of those conversations are starting to be done. They are able to kind of come to us and ask the questions, and we're happy to help with that. I think that's.
We also always encourage the founders to think about what they want their round composition to look like and what kind of background or expertise they want on the table. So if we're looking at something, for example, in the healthcare space, set aside the fact that we selfishly would love to have a healthcare expert on board to provide more of that sort of strategic guidance and business development support and all that. But we're like, it's also better for the company, right? Like you as a founder should want to have a specialist for this kind of business. Or if we're doing something that's deeply technical, given we're generalists, it's like, okay, at least someone involved here should bring that technical expertise.
And it doesn't look good if this is a healthcare deal
With no healthcare
and a B2B
investor.
SaaS is leading it, So we can play the lead here and do that, but actually in the interest of the founder, really, let's go get a lead as a healthcare. We're going to follow. We're here. We're going to follow. But it's really about setting you up for success for this round and closing it quickly, but for the next round as well, which is another.
And we also will defer to just the founder's preferences in a lot of cases. And sometimes they'll have people who are looking for a co-lead, right? They have an investor who's like, we want to do this, but we want a co-lead. We're like, great. If you have that person, we're definitely open to it. Like, we don't have to be the sole lead here, taking whatever credit seems to be associated with that.
What advice do you give founders on round construction and who they should have? So you mentioned like the sector focus. What else do you think is important?
It could be sector focus. It could be stage focus. So we often get founders who come to us and are like, okay, we're thinking of raising a $2.5 million seed round, but we talked to this really big fund and they would do a $5 million seed round. Should we do that instead? And so I think a lot of it is around aligning sort of incentives and expectations on milestones. So, as an early stage focused fund where our bread and butter is pre-seed and seed, our bias obviously skews toward at the early stages, you want to have people who are going to be actively involved and invested in you being successful over the next 18 months versus someone writing a placeholder check and then if things go well, great, but if you need help, you can't find them, right? So we think about that. It's like, who do you want? And maybe there's a way where you can have both, but like you should definitely have at least someone who is invested in what's going to happen over the next 12 to 18 months. Sometimes there's also a geography element to it because we're based on the East Coast. We found in a lot of our investments, it's been helpful to also have a West Coast investor because the networks are very different. Like they could be really helpful on the East Coast for customers, for business development, for hiring, and for some subsegment of follow-on investors. But the West Coast networks are just, it's kind of its own animal. So we found that it's nice to have that that balance. So all of this, it can be case specific, but these are all factors that we're thinking about when we're rounding it out.
And also things like the size of the funds that you currently have and how many of them participating in follow-on. Because we
Yes.
place a lot of importance on capital strategy at Laconia, we really try to help the founder think not only how are you closing this round, but how are we closing the seed and the Series A? So how are we getting to the next round of financing and how do we get there strong? So A, what are the milestones to get there? But B, who around the table do you have that will be able to at least somehow participate perhaps at the next round of financing? So I think that's another thing that we're thinking about is kind of who do you want around the table? And not everyone, you want those that will be pre-seed and involved, but maybe there's an allocation saved for that person that will be able to double down for the A once that comes around the corner. And it's just thinking ahead that way as well.
Yeah. Can I just caveat everything that we just said? Which is, I feel like sometimes founders like hear this and then they over-index on it. And they go and they tell investors, they're like, we really want you on board because you're going to help us do all these things.
Which is not what they want to hear.
No investor wants to hear that. They're like, no, you, at this point, you already, like you're reliant on our help? No, right? Like, yes, investors want there to be areas where they can move the needle on the margin, push things forward, but everyone is looking for companies that are going to be successful with or without them. And so I think the positioning of that has to be like, here's all these strengths that we have. Here's why we're really excited to work with you. Here's how we can get there faster with you involved. Yeah. But it's not, here's why we need you.
Definitely.
That's not the angle.
This is more for like a founder to construct the round as opposed to a founder telling the investors. But yeah, absolutely.
Yes.
That makes a lot of sense. Okay, so we want to hear a little bit about the stories you say you have. You've been around for a long time. But, we don't have to delve into all of it because we'd be here for a while, given all of your experience. But can you tell us about, some of Laconia's winners or successes and what you've learned from them?
Yes, for sure. Yeah. Some of the stories are more for a dinner and drinks conversation rather than a weekday lunch. But I'll share a couple of things that I think are sort of relevant to the market that we're in right now. I'll start off by saying that we have been, obviously, the same way as founders have been, we've been fundraising since 2015 up until now, and we've seen a lot of that market impact on our end too. So we're not isolated from the impact of everything going on here. When we initially started the firm in 2015, there was a very clear seed to Series A gap. The initial premise and thesis was a lot of companies have raised 500K, 750K, usually friends, family, angels, that kind of round, maybe an accelerator. Their next round is supposed to be an institutional Series A, but as the asset class grew, Series A funds were like, we want $1 million, $2 million, $3 million in revenue, and now you had what do we do with this in-between period? So we were calling that late seed. It was you've raised some money, but you need more of it. Market shifted, Series A moved earlier, lots of seed funds entered the market, all of a sudden everyone's doing seed, right? And there was sort of this abundance of capital over that time period. We are now seeing that pull back again. And so one thing I would note is that the definitions of all these things are constantly shifting just based on what overall investor appetite is. And right now we're in a place where a lot of those Series A milestones are, not only are they being pushed out again, but they're less clear than ever before. And so I think that's creating an interesting dynamic for seed companies where it's really hard to plan. What we've seen in terms of success over the years is, when we were investing in companies in 2015, 2016, talking about capital efficiency, break-even optionality, fundamentals, everyone was like, what are you talking about? There's money everywhere. Just go, go, go. Now we seem a little bit less crazy when we talk about that sort of thing. But we've had, companies that even predate the institutional funds, like Triple F's, which is one of the ad tech success stories, MarTech success stories, which you're familiar with.
We realized earlier that we co-invested in Triple Lift. This was in 2012?
2012, something like that.
Yeah.
Multi-billion plus dollar exit there. We've had others in the portfolio like Promote IQ, which was in the retail tech space, vendor marketing platform that was acquired by Microsoft. Very quickly after we invested, which was nice as well. Our LPs were very happy. It doesn't always happen that way. And then we've had, some big success stories in, the fintech space, companies like AutoFi, Oculus, et cetera. And I think with a lot of those, the common thread was they were very focused on who the initial customer is. They had a very clear ICP. They knew exactly what that problem and pain point was. They had done extensive customer research and discovery and problem validation before they went out and raised, millions of dollars. And they were able to get on a growth trajectory that allowed them to scale quickly and reach some amount of critical mass. And I think that's one of the challenges right now. It's how do you balance what everyone's talking about now, which is like profitability, break-even optionality with growth. The reality is that most pre-seed and seed companies can't build, a venture potential business and be profitable before Series A. So it's about being really intentional about what those focus areas are, what those key milestones are, and what you really need to prove out and validate to continue to grow. Because we fundamentally need 5 to 7 years at least of everyone sort of believing in this long-term vision and having buy-in in the investor base of like, this is going to be really big. And it's very hard to do that when you're like focused entirely on profitability. That just turns into a different kind of business.
Right.
Makes sense.
Anything else to?
No, you were there for 10 years. So. You know all the stories.
Do you think that today there are investors and founders out there that are kind of over-focused on that getting to profitability?
There are. I mean, look, I think things that are helpful about those conversations and those analyses are understanding what the cost structure of this business is. Where do you have variability? Where could you ramp up or pull back? In a lot of cases, the reality is that if you had to do that, it would probably take you off that venture track.
Yeah.
Right? You wouldn't be able to then go out and raise a Series A, right? If you go to profitability, you're no longer growing 3x year over year. You're no longer showing that upside potential. You're not going to get a 10, 15x multiple to go raise your Series A, right? Now it's a different outcome, which is not necessarily bad. That might fundamentally be the best outcome for the business, but that can't be the strategy if the goal is continuing to raise venture and continuing to build toward a multi-$100 million business. So I think it's helpful to always have sort of a plan A, plan B, plan C, but you still need investor buy-in on here's why we are not going to do this. Here's why instead we're going to invest in these key areas and prove these things. And here's what we've done to garner future capital support and to know that there is a path to this being a viable venture-backed business moving forward.
Now, are there specific milestones or traction numbers that you look for when you invest at pre-seed versus seed?
You want to take that?
Definitely. It's funny, what is pre-seed and what is seed, but I think we do actual pre-seed investments. We do invest in a pre-revenue and or pre-product company, but still at the early stages, we would want to see conviction. So even if we don't have revenue, what other signs of qualitative signs of market product validation can you show? Excuse me. One example I can give, we made a pre-seed investment in a founder that had 2 pilots of 10K each. That is it. MVP that's working and 2 pilots of 10K each. On the surface, maybe some people will say it doesn't hit the milestones of what we need. We will be crazy to invest in it. But when you dig deeper at the qualitative behind it, this guy, to Jerry's point around clear ICP and plan, has conducted multiple interviews in 3 different sectors, decided which of the 3 sectors is the sector he's going to go with first and why. Within each sector, figured out who the top 30 customers are, went to the top 2, got the 10K pilots with them, the other 10 are on a wait list, and the top 2 are willing to give him an hour of the time every week while they figure out the pilot. So while under surface, we could say we're looking for a revenue metric, or we want you to have an MVP, that doesn't really tell the story. For us, it was a founder with deep expertise, analytical, showed us qualitative signs of market demand, had a very clear ICP, a very hairy problem, because if a VP of engineering is willing to spend that time with you, then, to solve it, at a multi-billion company, then VP of executive of a level, then that to us kind of ahead. So I think that will be for us the things that we need to nail. It's not 20K of MRR. It's not number of customers. It really is a case by case, trying to hit those 4 questions, which is what is the hairy problem? What is your ICP? Show us qualitative or quantitative signs of market demand, and then seeing that the founder has the right expertise for that. Would you agree?
No, that's right. I mean, the longer we've been doing this, the more we've moved away from arbitrary parameters of like, have to check this box, that box, that box. It's like, well, actually, like, why does that matter? Like, what are you actually trying to de-risk or validate with this? And is there another form that gives you that answer? So I think we've just really gone, particularly the earlier stage you go, more into these qualitative rationale types of
like first
indicators. Yeah.
Okay, I'm going to ask like 2 more questions, okay, and then we're going to have lunch. It's coming. So the first thing is, what are you looking for? What are you excited by? I know it's only the very sexiest of ideas, right?
Yeah, I mean, we often joke that we look at all the boring stuff that makes money.
I think everybody's happy with that here.
Exactly.
Right?
Yeah,
We've all got
exactly.
B2B SaaS founders in the room.
Yes.
We're all on the same page.
We get each other.
Yeah, I mean, Miri mentioned a couple of the areas that we're looking at. We are spending a lot of time in healthcare, vertical software of various types, fintech, and then e-commerce enablement and retail tech. Those are probably our top categories. But fundamentally, we are looking at, some unique insight that a founder has through deep experience in the space. And it's super qualitative. It's hard to position around it. We kind of know it when we see it.
Yeah.
But we really are looking at things that are solving deep customer problems. We're seeing so much now that's positioned around like AI co-pilots, Gen AI, all of this, like branding around that. And for us, we're always like, who's the customer? What do they need? Why do they care? How do they validate that this solves a problem for them?
Awesome. Okay. One other question for you is, what does the process look like for a founder that wants to pitch you, and what should they expect?
Yeah, great question. I'd love to answer. So we accept cold inbound pitches. We read every one of them and we respond to everyone. So we have a contact form on our website, but we will also distribute our emails. You can always email us a pitch deck, but founders can always reach us very freely on the website. We also try and do these type of things and be as accessible and available for founders. So that's how they can reach us. What to expect from the investment process. We are a lean but ambitious team of 4. So actually each one of us takes the first initial call. So for the discovery stage, what it looks like, if there's a fit, once you kind of submitted your pitch, we'll jump on a 30-minute call to just see if there's a mutual a fit as a start, try to kind of just validate the market and the pain. And if we are excited, the second stage is for you to meet all of us. You can't get rid of us. We all jump on a call. And the reason we do that is that we want to be respectful of your time. We want to make sure that everyone is on board with you, that you are on board with us, and that we're excited about what you're building and what you're solving before we dive into the due diligence process. So that's a discovery. From then we move on to the due diligence process, which could take anywhere between 1 to 3 weeks, depending on whether we lead or not. That will include 2 parts. The first part will be us really honing in on your go-to-market strategy. All of us are operators. We are salespeople ourselves. We've done marketing ourselves. So we really like to kind of index on your sales pipeline, your go-to-market strategy. How are we actually going to sell and how are we going to grow? And then also, like I said, we like to look at the strategy around capital. So what are the milestones? What is your pro forma P&L? And what are the milestones that we're going to hit for the next round of financing? That's the hairy, heavy part of the due diligence. If that all goes well, then we're kind of at the home stretch. The second part is, doing due diligence and references call. Here we're also trying to be respectful of your time and your customer's time. So we will try and, instead of talking to existing customer, perhaps try and speak to prospective customers. That way we get an unbiased view on your value proposition.
To
But
be clear, those are the ones that we introduce you to. It's
Yes.
not like your pipeline.
Yes,
It's like,
exactly.
there's people we know who might be customers. Do you want to talk to these people?
exactly, we try and do a handful of introductions to people within our network and make those connections for you. That way we get a view about your value proposition, but then hopefully whether we invested or not, you got prospective client conversations. And that's it. I think those are the main things. There are things like technical due diligence, the references and things like that, but the meat bulk of it is the discovery and then, speaking to prospective customers and diving into financials.
Amazing. Well, we will make sure everybody gets your contact information. And thank you again. So Jerry and Merritt will stick around for lunch so everybody can, we're just going to have open conversation. And thank you again to Roe for sponsoring this, our favorite business banking platform. And that about wraps it up. Thanks, everybody.
Thank you.
Thank you.